All right, we are going to try and make sense of what was a truly chaotic week in the markets. I mean, we saw assets just completely collapse, entire sectors getting obliterated, and the stories investors tell themselves flipping on a dime. So how do you decode all of that? Well, we're going to do it through the lens of legendary investor Steve Eisman's latest analysis. Okay, so here's what we're going to cover. First, we'll look at the pure, unadulterated panic that slammed into silver and crypto. Then we'll get into the AI wrecking ball and why it's just crushing software stocks right now. After that, we'll see where a contrarian like Eisman is actually finding opportunities in the wreckage, check in on some key earnings reports, and then wrap it all up with the biggest lesson of the week: how fast the market's favorite stories can completely fall apart. So let's kick things off right where the action was hottest, where you could almost feel the fear in the air. This is where we saw confidence just evaporate, leading to a shocking collapse in assets that, some people thought were basically bulletproof. It really all started last Friday. You had silver, which had been on this huge run-up, and then bam, it just collapses 26% in a single day. A move that big, that isn't just people taking profits. That's a sign of something much worse: forced, desperate selling. And this wasn't just some isolated event in commodities. In just 4 days, Bitcoin, the supposed digital gold, it plummeted an incredible 24%. This wasn't a slow bleed. This was a really rapid, violent downturn across the board in speculative assets. So what on earth happened? Well, Steve Eisman's take really cuts right to the heart of it. He says this wasn't some subtle shift in market sentiment. Nope. This was a straight-up wave of forced selling from speculators who were way too leveraged. They got what's called a margin call, which is basically their broker screaming for more cash, and when they couldn't come up with it, they had to sell everything, at any price they could get. And all this volatility really shined a bright light on a huge difference in how these things actually behave. The whole argument that crypto is some kind of safe haven, a hedge against market chaos, it just completely fell apart. Instead of acting like gold or silver, cryptocurrencies moved in perfect lockstep with the most speculative tech stocks, proving, yet again, that they're really just vehicles for speculation, not safety. So, what's behind all this fear we're seeing in the tech space? Well, it turns out that the biggest innovation of our time, artificial intelligence, is also acting like a giant wrecking ball for an entire industry. I mean, the big story this week, hands down, was the absolute devastation in the software sector. Stocks were just getting hammered left and right, which really begs the question, what is going on? What is driving this massive collapse in confidence? What's really fascinating here is the total paradox that's playing out. Investors are so terrified that AI is going to make all these existing software business models obsolete that even genuinely fantastic news can't save a stock. Take ServiceNow. They reported great numbers, really great, and the stock still dropped 10%. The fear is just completely overwhelming the actual facts. And if you want to understand the sheer scale of the AI arms race that's fueling all this anxiety, just look at this number. Google announced it plans to spend an astronomical $180 billion on AI-related capital expenditures in 2026 alone. Just to put that in perspective, that's literally double what it spent in 2025. And this spending war led Eisman to a pretty stark conclusion. With giants like Google dropping cash on this scale, how can a startup that's burning through money like OpenAI possibly compete in the long run? If their venture capital backers ever get nervous and decide to turn off that money spigot, well, it could be game over. Okay, so in the middle of all this panic and fear, Eisman is doing what he does best. He's finding opportunity. He's looking for value where everybody else just sees ruin, and he's betting against these big negative stories. So first on his list is Charter Communications. Now, this is a cable company, and it's in a sector that is so hated right now, most big institutional investors have completely given up on it. For years, the only story you've heard is cord cutting, competition, it's over. But here's the crucial point. The investment idea here has nothing to do with subscriber growth. It's all about a massive and pretty predictable increase in free cash flow. See, the company's finishing a huge upgrade cycle, and that means its capital spending is about to fall off a cliff. And that, in turn, is projected to cause an explosion in free cash flow per share, from about $32 in 2025 to a potential $121 by 2029. Okay, now for Eisman's next bet. We need to quickly understand a key metric, especially for home builders. It's called tangible book value. Just think of it like this. It's the company's liquidation value. It's what you'd get if you sold off all its hard, physical assets. It's a really basic measure of what the business is truly worth. And that brings us to Eisman's other contrarian play, Meritage Homes. This is a home builder, and it's trading right at 1x its tangible book value. Historically, for this sector, that's been a classic entry point for value investors. It basically suggests the stock is priced just for its assets, with almost no value being given to its future ability to make money. All right, let's widen our lens a little bit. The week's big earnings reports gave us some really important context, and they revealed a super sharp divide between the companies that are absolutely thriving and those that seem to be, well, fundamentally broken. And on the losing side of that divide, you couldn't find a company more broken than PayPal. Eisman's take here is just blunt. He says the company is facing an existential crisis because competitors, especially Apple Pay, have just built a way better mousetrap. It's leaving investors wondering, why do we even need PayPal anymore? I mean, the company's performance is just awful, right across the board. They're missing their targets, their guidance for the future is terrible, and they're cycling through CEOs. But the real shocker is where the stock is today, down a stunning 87% from its peak in 2021. That is a truly breathtaking fall from grace. But then, on the complete opposite end of the spectrum, you had the undisputed winner of the week, Eli Lilly. The company reported earnings per share of $7.54, which absolutely smashed expectations of just $6.67. And this performance just brilliantly shows that even in a really nervous market, a company that has a totally dominant product and incredible growth can still do incredibly well. Eli Lilly is winning the weight loss drug war, its revenues are just exploding, and you can see investors rewarded it handsomely for that. And all of this brings us to our final and maybe the most important takeaway from this whole chaotic week. It's a really powerful lesson in how the stories we tell ourselves about the market can change in the blink of an eye. So here's the crazy part. The exact same data point, this massive capital spending on AI by companies like Google, was seen as a huge positive last year. It was a sign of investment, a sign of future dominance. It was a reason to buy. Now, that very same data is seen as a huge risk, and it's spooking investors about declining free cash flow. The data didn't change at all, but the story did. And this really just leaves us with a final kind of provocative thought. If we're in a market where the stories, the narratives, can be more powerful than the actual numbers, then the most important question for any investor isn't just, what does the data say? It's which story is about to break next.